Good morning from cloudy and warm Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thank you for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, May 18th, 2026. Since I was with you last, exactly 2 weeks ago, the U.S. stock market has remained driven primarily by strong AI-related earnings growth and continued leadership from large-cap technology stocks, although rising long-term interest rates have created increasing volatility, particularly over the past week. Long-term Treasury yields surged as investors became more concerned about persistent inflation, large government deficits, and the economic impact of higher oil prices tied to Middle East geopolitical tensions. While the broader global economy has remained relatively resilient, growth expectations have softened somewhat as central banks remain cautious about cutting rates too aggressively. Overall, the environment continues to resemble a late cycle expansion characterized by solid corporate earnings and technological investment strength, but with growing financial stress from elevated borrowing costs, inflation risks, and geopolitical uncertainty. In just about a minute or two, we're going to look at some key charts, some important data series, and some of Asbury Research's own data-driven models pertaining to current market conditions, particularly how much this explosive rally that we had. I think the S&P is up 12 or 13% from the low that we made on March the 30th. We want to look at that sustainability and see if there are any signs that the market may be running out of gas here, at least on a near-term basis. But before we do, let me just tell you a little bit more about us, a little bit more about Asbury Research. Asbury Research is a registered investment advisor that has been providing investment research to individual investors and professional money managers since 2005. Asbury emphasizes what we call intelligent diversification, an actively managed approach designed to adapt to changing market conditions rather than relying on the traditional static set it and forget it allocation models that have been around for a long time, and frankly, they just don't work very well anymore. For self-directed investors, Asbury offers both its flagship Asbury Premium Research Service and a lower-cost Substack newsletter featuring select reports, models, and market commentary. For investors who prefer a managed account, Asbury offers 4 proprietary model portfolios that were built on our own models, including the Correction Protection Model, or our CPM model, and the CEIF model, designed to achieve competitive market returns while also reducing overall portfolio risk, which is really key for us. These model portfolios have undergone extensive backtesting and have been traded in real time for nearly 2 years. Let's change views here real quick and just take a look at a couple of those. These are the model portfolios year to date. Our Asbury Aggressive model, which you can see on the bottom, has outperformed the S&P 500 by 4.8% year to date, with approximately a 50% lower maximum drawdown than the S&P 500 and a significantly lower standard deviation. Our Asbury Balanced model portfolio, which is second off the bottom, has outperformed S&P by 1.7%, with approximately a 60% lower maximum drawdown than the S&P 500 and an even lower standard deviation. Finally, our Asbury Conservative model, which is the second from the top, has been a relative performer versus the S&P. In other words, it's been staying right with the S&P in terms of the performance side, but with approximately 3/4 less maximum drawdown, 75% smaller maximum drawdown, and a standard deviation approximately half that the S&P 500. So the general theme is here trying to give you the market with a lot less risk, and that's what we've been able to do thus far this year. Full disclosure, all of my own equity dollars, all the money in my own personal account that I allocate to equities are all invested in Asbury models. Now, let's get started. Let's get to the reason you're here. And we're going to switch our views again. And we're going to start by looking at the Asbury 6. So let me jump right here. So this is inside the research center. This is inside the paywall. And this is our Asbury 6 model. The Asbury 6 is meant to be an indicator rather than a model. It's a daily indication of the broad market's internal strength. I call it a daily EKG for the stock market. The reason I built this, and I kept this internal for a few years, was because over the past 8 to 10 years, the daily volatility in the S&P 500 has really increased. There's a lot more erratic day-to-day movement where the S&P could be up 100 today and down 75 tomorrow. And if all you're doing is staring at the S&P, it's very easy to get thrown offside, thrown out of a good idea, and then 3 or 4 days later, you're buying fresh highs. This was meant to try to keep me, who's been doing this for 40 years, from making that kind of a mistake. The Asbury 6 on a performance basis, it's underperformed the S&P 500 by about 2% on an annualized basis since 2017, but its maximum drawdown of 13.6% is a third of the S&P's max drawdown, which is 33.9%. It's active. There's about 9 round turns a year. In other words, it goes from positive to negative about 9 times a year. It's part of our premium research subscription. And how it works is 4 or more of the 6 constituents that we can see here, which is the rate of change in the S&P 500, relative performance of stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth. 4 or more of those that are green indicate a positive reading for the actual metric. 4 or more have been green now since April the 8th, and the S&P is up by as much as 14% since then. But what we've seen for the past 3 days is now we're 3 and 3. So we're not quite 4 red. 4 red would turn the A6 to a negative reading, but we've been 3 and 3 for the past 3 days. So what does that mean? That means that either the S&P 500 has to be strong next week, coming right out of the gate on Monday, or we're probably going to go in some kind of a correction. You can see the rate of change in the S&P, the trading volume, and the market breadth are all red. So this is something that we're going to be really focusing on because, again, if the internals start to turn negative, and that would be 4 or more red, it will indicate that we have some kind of a near-term peak that's been established in the S&P 500, and we may be weak for a while. The second thing we're going to do is I'm going to go back here. I always talk about drawdowns, and I think a little bit of explanation is probably in order here. As you can tell, I'm an older investor. When you're 35, if the market goes down, it's not a bad thing. Figure if you're 35 years old, you're in the first quarter of your investment football game, to make the metaphor for football. That means you can do some risky stuff. You can throw the ball downfield. You can handle the ball in the backfield. If you make a mistake, if you fumble the ball, there's a lot of game left. So the risk, taking risk is a lot more palatable. Once you get into the fourth quarter of your investing career, like I am, the game changes. Just like in football, you don't see a lot of chances being taken by good football teams that have a lead going into the fourth quarter. They tend to do a lot of running plays. They give the ball to their to their sure-handed fullback and try to run the clock and score again if they can. Take a look at this chart. The S&P had a maximum drawdown of 34% back in the beginning of 2020. That was during the COVID period. So here, if the S&P drops 30%, mathematically, you need to make 43% the other way in order to get back to where you were before the correction started. COVID came back pretty quick after we bottomed. I think March 27th of 2020. I think that was a COVID bottom. Came back pretty quick, but that's not always. What if we have a 33 or 35 or 37% correction this year? We've gone a long way in a relatively quick period. What if you got to wait 3 years or 4 years to get that back? That was the case back at the top in 2000. Now the clock's working against you if you're an older investor. So I just wanted to make a mention of that. This is why we put so much emphasis here. We're not going to talk about our CPM model today. but CPM is a risk on and risk off model. So when it's risk on, we're in the S&P 500 or SPY, the ETF. And when we're risk off, we're in BIL, which is the yield of a 1 to 3 month treasury bill. So here's 2018. The S&P drew down 19.8 and CPM drew down 15.10. So about 4.5% less. Not huge, but less drawdown. Here's where it matters. In 2020, the S&P drew down 33.9. CPM only drew down 9%. In 2022, S&P drew down 25.4, only 20.20, or a little bit more than 5% less. Last year, in 2025, we had an 18.9% drawdown in the first part of 2025. The CPM only drew down 9.3. So this is why we put so much emphasis there. The next thing we're going to do is we're going to look at sector rotation. So we're going to go back to the Research Center. And you can see here up at the top is where most of our models are. So we're going to go to the CEF model. And let's get to the graphic right away here, make it a little bit bigger so we can see it. The CEF model is a model that we built for alpha generation, as opposed to the CPM, which is for reducing risk. So the CEF model is a completely data-driven sector rotation model created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector SPDR ETFs, which all of these together is the S&P 500. So basically, within the past 7-8 years, sector rotation really sped up. It used to be if you were overweight a sector, you could ride that overweight for a quarter, sometimes 2 quarters. Now it seems like it's 6 to 8 weeks. It changed for a lot of reasons as the markets evolved, as electronic trading has evolved, everything has sped up. So we built an algorithm here that measures the velocity of money moving around those 11 sector SPDRs. And we do it in 3 different time frames: trading, which is a week; tactical, which is a month; and strategic, which is a quarter. And then we rank them. So technology, heading into next week, the fastest money in all 3 time frames: trading, tactical, and strategic. So we have a ranking score of 3. The composite score is 1 + 1 + 1. Second is materials with a ranking score of 12, and consumer staples jumped out of the basement. It's been down there for quite some time because we are number 2 in trading and number 3 in tactical. That shows that you're starting to get some defensive money that is moving into safer places. We haven't seen staples up in the top 3 for as long as I can remember, but that's the way things are setting up now. And down in the bottom, we're avoiding utilities and financials because those 2 are on an avoid ranking. That's why they're red, and they have relatively high scores. So the money is moving into tech, materials, and staples, and out of utilities and out of financials. So according to our back test, the CEF model has very significantly, I should say, outperformed the S&P 500 on an annualized basis over the past 8 years, but with a slightly lower maximum drawdown than the S&P 500. CEF's been trading now in real time for via managed accounts for almost 2 years for both individual investors and for portfolio managers. There's opportunities for both participate in the CEF model. And I've been trading it in my account for much longer than that. In real-time trading throughout, or I should say through the end of last week, the CEF model is up 8.7% year to date and is outperforming the S&P 500 by 3.2%. Next thing we're going to do is we're going to go back to the Research Center and we're going to take a look at our ETF trade ideas. So back to the Research Center. And here are our ETF trade ideas. So we have several different aspects to the premium service. They all do different things. I always say this is kind of like going to a smorgasbord. You don't have to eat everything on the table. You pick the stuff you like. So for investors that are more comfortable making short-term trades, these are for ETFs. And so we quantitatively scan about 6,600 ETFs every day, every morning, early in the morning, for a predefined combination of positive price trends, relative outperformance versus the benchmark S&P. You can see I'm reading right here, and expanding investor assets. It comes up with a short list that check all those boxes. I then go over them using my experience of doing this for 40 years, and I try to determine the ones that have the best risk to reward, something that maybe just broke a trend line or triggered a chart pattern or is on a support level, something so I try to get the risk reward in my favor as much as I can. We've been doing these now for 3 years. We started in the middle of March of 2023, and this is through the end of March of 2026. We've had a total of 127 trades, comes out to about 3.5 trades a week, not by the calendar, but by the opportunity. Average profit per trade is 1.7%. You might say, well, that's not a whole lot. Well, looking at these numbers a little deeper, 53% of these trades made money. Our average winning trade makes 5.6%. And we're in that trade for 20 business days, or just a shade underneath 1 month. Our losing trades, we're only losing less than half of that, 2.6% on the losers, and we're in those for 8 trading days, or about a week and a half on the calendar. Our Sharpe ratio is a very, very respectable 1.3%, especially going across 3 years and trading all kinds of assets, and not just one particular asset that might have had a good 3-year period. And our maximum drawdown is a minuscule 3.7. Let's look at some of those trades. So these are the current trades that we have open right now. This is in the upper part. And the one we're going to look at here is OEF. So we bought OEF on 428. Our target was new all-time highs, which we're at now. Valid above is where our soft stop is. We don't believe in hard stops, and we're up 5% so far. We're outperforming the S&P by 1. And here's what it looks like on the chart. So here's OEF. So we bought OEF here. This is a daily chart of OEF. And we bought it because we had the positive price trend, we had the relative performance, and we had the asset flows. And I put my own spin on it, finding the one that had really good risk reward, because we just had broken out of this big resistance level here. So we bought them here. You can see we're up about 5% so far, 5-6% so far in about 2.5-ish weeks. And this is versus the S&P. This is OEF versus the S&P. And you can see that we've had a relative outperformance here. So that's another aspect of our service. OEF is the S&P 100. It typically outperforms the 500 when the market's strong. Like, look here. When the 100 was underperforming the 500, was between December 31st of last year and let's call it the end of March. And that's when the market dropped. That's when the S&P 500 dropped. You can see the OEF dropped. So this is actually a bullish configuration with the 100 outperforming the 500. The next thing we're going to look at here, we're going to go back inside the research center, and we're going to look at keys to this week. Keys to this week is one of our oldest reports. As the name suggests, it's once a week. And what we do with keys is Jack and I probably look at 100, maybe 150 charts, and we try to find those that we think are the most germane or the most important to upcoming market direction. So we're going to look at a couple of those. We're not going to look at all of them, but we're going to look at some. And this is a new report that was just completed at the end of last week. Excuse me. So this is the S&P 500 daily. This goes back to June of 2025. And the takeaway here, the one that I wanted to give you, is when we broke out to fresh highs here in April, in the early part of April, based on the size of the decline, in this very report, I said that we had an upside target of 74.40. We hit that target on Thursday of last week, especially when you're at all-time highs. These artificially manufactured targets often work quite well because there's nothing tangible up above the market because we're at all-time highs. So now that we're at 74.40, that 3 and 3 in the Asbury Research makes a lot of sense to me. When you put them together, okay, the market's hit its target, and now we're starting to falter a little bit on the Asbury 6 side. If the Asbury 6 goes to 4 red next week, I'm going to start looking at the 74.40 as possibly being a more meaningful peak here, and the market is certainly due for a correction. The next one we're going to look at is chart 5. So we're going to scroll down here to chart 5. This is seasonality. Seasonality for us here at Asbury is kind of a tertiary indicator. I've never made a trade in my life based on seasonality, but when seasonality is kind of it's kind of intersecting with what you're seeing in real time, that's when I pay attention to it. So what we see here is the month of May is pretty well. Let's say what this is first. This is the weekly seasonal pattern for the second quarter going all the way back to 1957. There's 13 bars here for the 13 weeks that are in the second quarter. Green is April, blue is May, and orange is June. So you can see outside of a week or two here, it's a pretty soft period for the market. So again, blended in with what we may be seeing emerge in the Asbury 6, this tells me a little bit about what we might expect in the weeks ahead. Next chart we're going to look at is number 9. Now this is the 30-year note index from the SIBO. TYX is the CBOE 30-year Treasury note index, symbol TYX. Look what's going on here. We're really close. The July 2009 peak was 50.66, which is about a 5.07 30-year yield. We're through that now, and we're closing in on this 51.22 on the index, which is a 5.12% yield. If we break out here on long-term yields to new, would that be a 16, 17-year high? That's a big deal. That's the market starting to price in more inflation. It's certainly the way that we see it, especially with what's going on with higher food prices, certainly higher gas and energy prices. So this is a chart, although there's no linear correlation, there's no direct linear correlation between this chart and the S&P 500. More broadly, if we get 16-year highs in long-term interest rates, that's going to be something that not only me, but a lot of folks are going to be paying attention to. Finally, let's go over here to Substack. I mentioned that we have a entry-level price Substack. The cost of the service is $25 a month. There's also a free version. So if you like our approach to markets and you haven't subscribed to this already, go to asburyresearch.substack.com and you can get it free a couple of times a week in your inbox. There's three different types of reports. There's our chart focus, which is right here. And this is very similar to Keys This Week. It's once a week, and we look at a lot of different charts and try to give you an overview of what's happening in the market and what you should start to pay more attention to. The other thing is our rainbow chart report is brand new. This is a part of our SEAF, our sector rotation model. These are the corresponding charts. These charts go all the way back 1 year and shows whether it's favored in green, neutral in yellow, or void in red. So what we're seeing here, industrial, starting to move into favored territory. If it stays there for a long time, you're going to get sustained relative outperformance there. Here's energy. Here's a great example. Energy from January 13th to April 7th, it got up into favored and stayed there. Look what happened to the relative performance chart that's down below here of XLE versus SPY. We had 37% of outperformance. Once it fell through here, basically at the end of the first week of April, look what happened, 17% of relative underperformance. These charts basically give you 1 year look back history on our CEF model and shows why it's so important. Here's financials. Financials are starting to roll back into a void, and look what's going on. XLF has underperformed SPY by 12% since February. And then there's one more, I think there's one more piece there. No, that's all of it. So this is basically what you have. There is one more. Stay with me. There's one more, and that's our sort report. I almost forgot. This is our sorting mechanism that comes with the Substack. We look at, I think there's 10 here, 10 pretty diverse types of assets. We go from U.S. technology, emerging markets, commodities, small cap, global equities minus the U.S., crypto, crude oil, gold, interest rates, dollar. It goes through a sorting process, again, based on trend, relative performance, and AUM, and it shows you which of these assets are clicking on all the boxes, checking all the boxes. Right now, it's technology, emerging markets, and also commodities. So if you're an investor and you want to quickly, quantitatively sort through all these different assets and see what's working, this is updated, I believe, twice a week in the Substack. So again, a low-cost way to really get a lot done in terms of your investment research. So there you go. That wraps it up for today. Our next Following the Money podcast is tentatively scheduled in 2 weeks, which is going to be May 31st, which will be Memorial Day. If you have any questions about anything that we're doing in terms of research, in terms of managed accounts, accessing our 4 model portfolios, you can go to the contact tab right here at asburyresearch.com, and we'll take care of you. We'll give you all the information you need. Enjoy your Sunday, and we will see you in 2 weeks. Don't forget to like and subscribe. Thanks for watching.